Welcome to The Explainer. Today, we're tackling a number that's really turning heads in the financial world, a forecast that gold could rocket into the five-figure range. Let's dig into the extraordinary case for how it might just get there. Yep, that's the number, $12,000 an ounce. A major wealth management firm is making this incredible call, and it suggests a huge surge from where we are today. So the question on everyone's mind is, how? How on earth could a chain of events lead to such a massive repricing of gold? And just to put that number into perspective, Swiss Asia Capital's $12,000 forecast doesn't just beat the outlook from big players like Goldman Sachs and Bank of America. It absolutely blows them out of the water. It is a serious outlier, and that's exactly why we need to understand the logic behind this ultra-bullish call. So what's really behind this prediction? Look, they're not just pulling a number out of a hat. Their entire case is built on 5 key economic drivers that they believe are coming together to create the perfect storm for gold. Here's the game plan they're laying out. It all starts with the Federal Reserve cutting interest rates, which feeds into a weaker economy, all while we're swimming in massive government debt. And at the exact same time, you've got 2 other huge forces at play, incredibly strong physical demand and central banks just snapping it up. So let's break down each piece of that puzzle. All right, first up, and you could argue this is the big one, it's all about the U.S. Federal Reserve. The direction of its monetary policy is basically the engine for this whole forecast. Okay, so this is a really simple but super important idea. When the Fed starts cutting interest rates, what you earn on government bonds, their yield, goes down. And all of a sudden, holding gold, which doesn't pay you any interest, starts to look a whole lot better. Why would you want a bond that's barely paying you anything when you could hold a real, hard asset, especially when things feel uncertain? But hold on, why would the Fed even be thinking about cutting rates in the first place? Well, that brings us right to the second driver, some pretty serious warning signs that are starting to flash across the U.S. economy. When you look at the actual data, things are starting to look a little shaky. We're seeing some weakness in the job market, the housing market is cooling off, and this is a big one, more and more people are struggling to pay their credit card bills. Every single one of these things puts more pressure on the Fed to jump in and cut rates to get the economy going again. And like we just said, that's pure fuel for the gold price. Okay, driver number 3. Now we're zooming out from the day-to-day data and looking at a much bigger, more structural problem, the absolute mountain of government debt in the West. Here's the bottom line. When governments are this deep in debt, you have to start asking questions about the real long-term value of their currency, right? The big worry is that they'll just be tempted to print more money to pay the bills. And what does that do? It devalues the currency and kicks off inflation. In a world like that, gold's classic role as a true store of value, a safe haven from exactly that kind of thing, becomes, incredibly important. All right, let's switch gears to the 4th driver. This is all about the demand side of the equation. And we're not just talking about Wall Street traders, we're talking about what real people are actually buying on the ground with their own money. And what we're seeing here is just this incredible, relentless demand, especially coming out of Asia. Get this, even with gold prices hitting all-time highs, people are still buying up jewelry and gold bars like crazy. In fact, in some markets, they're actually paying extra, a premium, just to get their hands on physical gold. This creates a really strong foundation, a solid floor under the price. And now, for the final and maybe the most powerful piece of this whole puzzle. We're talking about the big players, the whales of the global market, the world's central banks. What's happening here is a huge strategic shift. It's not just that central banks have been steadily buying gold for years, they have. The really big deal is that now many of them are actively choosing to buy gold instead of traditional safe assets like U.S. Treasury bonds. Now think about that for a second. That's not just tweaking a portfolio. That's a huge signal that they're trying to diversify away from the U.S. dollar for the long haul. Okay, so we've just walked through all 5 drivers. So what? What does this all actually mean for how you should think about your own investments? It really boils down to 2 things. On one hand, you have the long-term strategy, thinking of gold as a hedge, something that protects you over several years, and as a great way to diversify when things get choppy. On the other hand, you have the key things to keep your eyes on right now, what the Fed is doing with interest rates, and what's happening with that physical demand from Asia, and of course, the central banks.
And on top of those five main drivers, you've got a few wild cards that could just throw gasoline on the fire. Things like new tariffs and escalating trade wars, a big acceleration in countries moving away from the dollar, or even something seemingly small like a supply disruption at a major refinery in Switzerland. Any one of these could kick gold's rally into an even higher gear.
See, at the end of the day, it's not about any single one of these factors. It's about the way they all line up perfectly. You've got the Fed getting ready to ease policy, a weakening economy, mountains of debt, and then this powerful, steady demand from both individuals and central banks. It's that powerful combination that builds such a compelling and bullish case for gold. So a forecast this extreme really forces us to step back and ask a fundamental question. Is the idea of $12,000 gold just a wild fantasy? Or is it a sneak peek into a future where the value of the traditional paper money we're all so used to is being seriously questioned and hard assets are returning to the center of the financial system? That's the thought we'll leave you with.